The ascending triangle pattern. I gotta tell you, it's one of my favorite chart patterns to look for when the market is in a bullish scenario. And it's one of those classical patterns, chart patterns that have been around for decades. Pretty much like the head and shoulders has been around forever. And perhaps it stood the test of time in terms of effectiveness. So why is it still around? Well, because the ascending triangle, when you look at it in the context of market action, it makes sense, especially when you look at it as a continuation pattern. And before moving on, I had some messages asking if that price pattern giveaway is still going on because I forgot to link it in the last video. It is, and you can download it from the link above or in the description below. And while you're at it, hit the subscribe button if you have a second. Okay, so why does the ascending triangle make sense as a bullish chart pattern? Well, let's look at what the pattern is in an uptrending market. It's a series of higher highs and higher lows. So traders are buying at higher prices in an uptrend with the expectation, however they came to that conclusion, that price is going to continue to go higher. So in the ascending triangle, price makes higher lows as shown by the rising trend line that's on the lows. Price makes similar swing highs that form a resistance line or a zone of price. The higher lows, what they're showing, as well as the smaller corrective declines, is there's a lack of downside interest. So why would traders buy at the higher prices when the price is not making new highs? Well, there is an expectation that price will eventually go higher with an upside breakout. So that's the power of this pattern. Traders are expecting more upside and they have no problem buying at the higher price. That resistance level, it shows that there are some who will still sell at this zone, but the higher lows show that they're becoming less involved to the downside. And there could be stops that are accumulating above the resistance zone for those who are shorting at that price. But we could also be seeing longs exiting positions at the resistance line as a risk control measure as well. So it's not always people shorting the market. And that coiled up buying pressure and the sudden realization from sellers that an eventual breakout to the upside is the intended direction, they bail out on shorting or selling at the price that's shown by the resistance line. And that said, nothing is 100% in trading, and that breakout to the upside can still fail. So how do we trade it? Well, there are a few ways that you can trade it, and eventually I'm going to show you my favorite use of it. But let's look at some common strategies around the triangle. The first one is just trading the breakout with a stop order. And I want to show with these charts that these patterns are not always as picture perfect as you saw in the graphic that I actually just had up. The concept here is the same though. We're looking for common price zones for the highs. It doesn't have to be an exact price. Higher lows going up into resistance, and that's what we're looking for. So in anticipating the breakout, traders can then place a buy stop order just over the top of the resistance area. But the main issue with this method is that markets do have failure tests, which is simply price probing the highs and then falling back. And with a failure test, which we commonly call a bull trap, you're going to find yourself triggered into the trade and almost immediately underwater with the trade because it's a false breakout. The second way we can trade these is with confirmation. So we enter on the close. So what we do is we monitor the resistance level. We enter on the close of the breakout candle or the bar. And here's another not perfect formation, but the concepts, especially where that small horizontal line is, are intact. You enter at market on the close of the candlestick if it stays above the breakout point as this one did here. Now the issue is that if the breakout candlestick was the next one, for example, that momentum one, that could lead to a snapback in price soon after you enter. And depending on your stop loss position, the risk and the position sizing on the trade may not be worth the reward because the momentum candles can sometimes just keep running. We could also wait for the breakout point retest. So basically this method has the breakout happen, you have some price action above the breakout point, and then a pullback and a test of the breakout location to confirm that the breakout's going to hold. Now that breakout pullback, that's a common trading pattern. Everyone probably knows it. And it's basically used from the horizontal range, the price pattern breakouts. So you can see that these patterns do take time to develop. And as mentioned earlier, the concepts are what matter. And although I'm using a bigger picture resistance line, you can see one forming lower. And you would allow price to break out and pull back to the resistance line, and you would enter your trade in that zone. So the biggest issue is that price could just take off and not pull back to that breakout origin. So one thing to keep in mind with pullbacks, the price can come back in to that pre-breakout zone and not violate the breakout itself. And I'm going to cover that later. So here is how I like to use it. And I find the most use is positioning before the breakout occurs. So in doing so, you get the benefit of instant positive feedback if momentum develops after the breakout. So here's some important points to that. I'm not looking for the ascending triangle pattern first. I'm looking for a horizontal range. That's what I need. And I can use the lower time frames for the price action. Now this is a lower time frame chart, but the range was found on the daily chart as noted by that top white line and the bottom yellow line. The dashed line, that's a secondary resistance zone where the break above right in the middle there was just an expansion of the range. Now that yellow splash, that's the area to notice. Price forms a bigger picture range. The smaller time frames highlights the ascending triangle pattern. We have basing under resistance, which is bullish. Traders enter their position in the basing zone. So what we've done is we've positioned ourselves before the breakout using a structure that's considered to be bullish. A more idealized pattern for the range, the ascending triangle, and the basing is in this graphic here. So the concept is clear. Buyers step in at higher prices. Sellers are unable to push price away from the resistance, their entry point, to get positive feedback on their trades. That's the basing. We're looking for the capitulation of sellers, the giving up of sellers, to help drive our trade through resistance and hopefully engage breakout traders. So does it work all the time? Absolutely not. But what we've done is we put the probabilities of one thing happening over another in our favor. And we just have to manage our risk and ensure that we place our stop loss. So where are we going to put our stop? Well, you're not going to ever have a perfect stop loss. And my choice for stop loss, generally 95% of the time, is using the average true range. But some traders will want to use some type of structure-based stop, which is also a great way to limit your risk on a trade. Now, some people are going to say, put the stop under the rising trend line at the X. Well, does that make any sense? You have a larger stop loss in distance. Price will break multiple structures if it breaks down. Trend lines, they can be drawn several different ways. So why does the yellow splash zone make more sense? Well, it respects structure, a support zone. Price pulling back inside resistance does not invalidate the breakout, but this level being violated could. And there's no need to let a trade run so far against you to the other side. But whatever you choose for your stop loss, just be consistent with every single trade that you take. Well, profits. Like stops, there's different ways to take your profits once the triangle resistance is violated. You can take multiples of your risk, 1R, 2R, and 3 times your risk. You can use trailing stops, and there's several variations you can use there. And you can use a pattern-based target. And let's explain those. So the pattern-based profit target uses the height of the pattern projected from the breakout point. So how do you calculate the take profit target? Well, you measure the height of the ascending triangle from the resistance line to the lowest low that forms the uptrend after the first resistance point. Take the height and project from the breakout point. And you can use the full target. You could scale out at 50% and move your stop to break even. And like our stop loss, whatever you choose to use for your strategy, for triangles or anything in regards to taking your profit, just be consistent. So let's have some final words here. I find personally the ascending triangle on lower time frames inside of a higher time frame rectangle range to be very useful. So this allows you to be involved in a position prior to the breakout, which can lead to some pretty explosive trading profits. And like all chart patterns, the concept matters, and not having a picture perfect pattern. Close is close enough, as you can see in the last chart that I had up. Finally, whatever approach that you're going to use, consistency with the right things, that's what matters. You get that right, and success is going to have an easier time finding you. Thanks for watching.